All right, y'all. This session of the course is going to be about risk management, and we're going to be talking about risk to reward ratios. We're going to be talking about stop losses, take profits, and position size. And we got to give a major shout out to our sponsor, Antarctic Exchange, the best trading experience in the world. This is a decentralized exchange made by traders for traders. And what sets this apart is, first of all, this is a decentralized exchange, meaning 100% self-custody of all your assets. You're not depositing your money into another company's wallet or platform. You're keeping everything self-custody in your own cold wallet or hot wallet. And because you're doing that, that means it will never ever require KYC or know your customer. The best part about Antarctic Exchange is ownership. All traders on Antarctic will get a portion of the trading fees that the exchange makes. And there's also an opportunity for you, the trader, to be the market maker and provide liquidity to the exchange. And in return, you will receive a proportionate amount of the market maker profits, including liquidation fees. Now, this has never been done before. Instead of your typical centralized exchange where everybody's trading against the market maker, and let's be honest, the market makers are the one who always win in the end. We are fellow traders trading against fellow traders, providing liquidity to each other, and it evens the playing field. Now, if you sign up in the link in the pinned comment and description, you will get the lowest fees, period, on any exchange right now that I know of. 0% limit order fees, 0.01% market order fees. This is a great deal on fees. It makes scalping on low time frames absolutely amazing because you can market in, market out, and make big profits on small moves. So make sure right now to go sign up to Antarctic Exchange. Links are in the pinned comment and description. I'll see you over there. What is risk management? Well, you hear it all the time. I'm sure you've heard it a million times. Never risk more than what you're willing to lose. If you are nervous during every trade you enter, then you are risking too much. If a single trade has the potential to make or break your account, you are risking too much. You need to be able to enter trades with as little emotion as possible, accept the fact that losses happen. Your risk management plan needs to account for losses. Now, guys, let me tell you, I take losses all the time, and that is simply just part of trading. You need to be comfortable with entering a trade, setting a stop loss, setting a take profit, and walking away, shutting your computer, shutting your phone, and sleeping sound throughout the night. That is how comfortable you need to be with taking losses. And the risk management is going to allow you to enter a trade with that calm demeanor because you're not worried about being kicked out of the game in one trade. Now think about this. A lot of traders might risk literally 50% of their whole trading stack in one trade because they don't know what they're doing. Let's say you have $100. You lose 50. All right, you just lost 50%. You feel really bad about that. Now your next trade is a win. Guess what? You make 50%. Whew, break even, right? Wrong. Because 50% of $50 is only $25. So even after a 50% loss and a 50% win, you're still negative 25%. You're still in the red 25% because you didn't use good risk management. And once you start taking losses, trust me, once you start taking losses that are more than 1 to 3%, the temptation to break your trading rules, the temptation to gamble and revenge trade becomes much harder to resist. And it's a slippery slope. Once you start gambling instead of trading, once you stop using good risk management, once you're in that position that you didn't plan for, and you know if this position gets stopped out or liquidated, it's going to really ruin your trading account, you have lost the whole game, guys. Okay? So in this session, we're going to go over how to set up your risk management strategy. It is generally advised for traders to never risk more than 5% of their trading account for every given trade. Now, there's a special formula you can use to determine how much money you're going to risk per trade. They recommend don't risk more than 5%. For me, guys, I like the 1-2% max rule. Okay? I like to risk between 0.5 and 2% per trade. And the reason why I like to do this is because if you set up your trades properly with good risk to reward ratios, you can risk 1% of your account and make way more than 1%. So here's what we're going to do. We're going to talk about how to calculate your position size. The first thing is risk to reward ratios. A risk to reward ratio is how much money are you risking per trade and how much money are you looking to make per trade. Now, for example's sake, we're going to take this kind of sideways range that Bitcoin's been trading here for the past few weeks, and we're just going to say, for example's sake, that we are looking to get into a buy or long position from right here, and we're looking to take profits at the top. Now, for example's sake, we're going to have to take it back down lower because we kind of missed the entry there. But this is like a valid trade setup. Let's say price came down to this level. This is where we look to buy. I mean, this is where I got in here, right? It's basically where I got in. I'm going to use the trade that I'm in right now as an example. I want you to notice something. My target for the trade is up here at $102,000. My stop loss for the trade is down here at $88,600. When we hover over this, and the way you're going to get this is by coming over here to the tools and trading view. I'll go over this more in the future. Forecasting and measuring tools. And you're going to click that long position. All right. You're going to click it on the chart. And then you're going to basically figure out where your target is, where your stop loss is, and it's going to give you a risk to reward ratio, 5.66. This means this is a 5.6 to 1 risk reward ratio. You're risking 1 to make 5.5. If you have $100 in your account, you're risking $1 to make $5.66. Now, what's very important about risk management, as you can probably already guess, is that we're not just looking at a chart and FOMOing into a trade by saying, oh my goodness, let me enter a trade right now. On the contrary, we're actually planning this trade in advance. This is a very important aspect of risk management. This comes with the analysis, but you have to make sure that every single trade you take, you have a plan for. You need to know where you're looking to enter into your trade. You need to know where you're planning to get out if the trade goes against you, and you need to know where you're planning to get out if the trade goes for you. These are 3 very important aspects of risk management. I'm going to write them down. Number 1, we need to know where do we enter. Number 2, we need to know where to get out if it goes against us. And number 3, where to get out if it goes for us. All right, these 3 things you must know in advance for every single trade you take, because if you don't know these things, guess what? You're no longer trading, but you are officially gambling. If you don't know these 3 things, you are no longer trading, you're gambling. I get people all the time on YouTube, Jason, what should I do? I'm in such and such a trade. Should I close it? Should I keep it open? That person didn't answer these 3 questions before taking the trade. Therefore, that person is not trading. That person is gambling. They are risking capital without a plan. Okay? So once we have these 3 things, where do we enter? Where do we get out if it goes against us? Where do we get out if it goes for us? We can then use this tool to kind of say, okay, I'm planning to enter a trade around here at $90,000. If it goes below, let's say, in my case here, for me, I had this plan. If it goes below $89,030, I will get out. Okay? This was my legitimate trading plan. I put this order here with my stop loss in advance, right? It almost stopped me out, but it didn't, thankfully. And then I have my take profit up here at $97,200. You can see here, this is a 7 to 1 risk reward ratio at that take profit. But I have answered already these 3 questions. I know where I'm going to get out if it goes for me, where I'm going to go get out if it goes against me, and I knew exactly where I was going to enter the trade from the level that I was prepared for, $89,900, right? And so now that we have all this information, what we can do is we can calculate our position size. The way you're going to calculate your position size is with this formula right here. You're going to take how much money you're risking in dollars. All right, so I'll put the formula right here. Your risk in dollars, all right? And you're going to divide that by your stop loss percent, and that equals your position size. Your position size is going to equal the amount of dollars you're risking divided by your stop loss percent. All right, so let's take a really easy potential trade here. Let's say we have $100 in our account, and this is the trade that we're looking to take. All right, we're looking to take a 4 to 1 risk reward, and we have a 2% stop loss. All right. So let's say we're planning to get into our trade. We're answering our 3 questions. Where are we looking to enter the trade? We're looking to enter the trade right here at 89,377. Why? There's some kind of technical reason for looking for a trade here. And then we tell ourselves, where do we get out if it goes against us? Well, we know that this is such key support that if we don't bounce from this support and we lose that support, then we do need to get out because we're wrong about our trading idea. So we're going to say our stop loss is going to be here at $87,503. Okay, and then our target is going to be up here at $100,000. So what we're going to do is we have $100 in our account. We want to risk 1%. So how much are we risking? If we have $100, 1% is going to be $1. All right. So we're going to take $1, and we're going to divide that by our stop loss percent. Now in this case, we have a 2% stop loss. So 2% becomes 0.02, and that's going to equal the amount of dollars that we put on the trade. Now, if we take $1 and we divide this by 0.02, that's going to equal $50. Now, we don't really need to do the calculation for this one because a 2% stop loss, you put half of your account on the trade, and after half your account goes down 2%, that's a 1% loss. So we would plan this trade. We say, okay, I'm planning for this trade. I know I'm risking $1, so because I have a 2% stop loss, I'm going to put $50 on the trade. And then, of course, if this trade gets stopped out here, we're risking $1. If it pumps up, in this instance, this is like a 6-to-1 risk reward. We're either going to lose $1 or we're going to make $6, and we're going to put $50 on the trade. Now, notice this. We're putting $50 on the trade while only risking $1. And while only risking $1, we're putting 50 on the trade and looking to make $6, right? See how that works? Now, let's say we have a much juicier entry, like if you're a scalper, which we're going to get into that later in the course. But a lot of times I will take trades and I have like let's say like a 0.25% stop loss, right? Or in this case, it's a 0.33% stop loss. Well, in this case, we would do $1 divided by 0.0033, and that's now going to equal our position size. So 1 divided by 0.0033. Now we get to put $303 on the trade. Now, you might notice something here, which is this. Okay, Jason, I only have $100 in my account. How am I going to put $303 on the trade? Well, this is where we get into leverage, and we'll get into that later as well. But for right now, we don't really need to worry about leverage. I'll tell you this. If you're new to trading, I would recommend that you probably keep your leverage at around 5x and just leave it there. All right, for now, just put your leverage at about 5x and just leave it there. Don't worry about it too much in the beginning. Don't worry about leverage too much. Focus on this formula, on this mathematical formula, and keep your leverage on like 5x and focus on this formula. So in this instance here, all right, let's say that we have a really good entry. We could potentially be now risking $1, putting $300 on the trade, and now we have a 37-to-1 risk-reward ratio set up. Now, this is one of those instances where, like I showed you in the last session, you're going to get small win, small loss, and eventually you're going to get a big runner where you got a really good entry. You could take a partial profit out in the beginning and then let the rest ride, and you can make a big percent on your account while risking $1. All right, so this is the formula right here. First of all, ask yourself these 3 questions for every trade you plan for. Number 1, where do I enter? Where am I looking to enter? Number 2, where do I get out if it goes against me? Number 3, where do I go out if it goes for me? Then you're going to take the amount of dollars you're risking. If you have $100, I recommend risking $1 per trade. You have $1,000, I recommend risking $10 per trade. You have $100,000, I recommend risking $1,000 per trade. And you're going to divide that dollar amount by the percentage of your stop loss. Remember to move the decimal point over to the left 2 spaces, and that's going to equal your position size in dollars. All right. So when you enter your trade, make sure that you're entering the order value in USDT and not in Bitcoin. We'll get into this more later when we talk about using the exchange. This is the basics of risk management right here, guys. Watch this video again until you thoroughly understand this. This works for any kind of trade: swing trade, scalp trade, day trade. If you are swing trading, for example, all right, let's just say, for example, you're swing trading and you're looking for those big moves from, like, let's say you're shorting this golden pocket here, and you're looking for a move down to $70,000, just as an example. All right, you can see this is an 11-to-1 risk-reward ratio right here. What does that mean? We have a 2.5% stop loss. That means we do our formula. Let's say we have $100. We're risking $1. We're going to do 1 divided by 0.024, and that means we put $41 onto our trade. We're risking $1 out of our 100, and we're looking to make $11. It doesn't matter if you're looking for a 27% move on Bitcoin, or if you're looking for, in this case, a 12% move, or even lower than that, guys. It does not matter. It's all about the risk to reward ratio. And while we're here, let me quickly go over one last thing, okay? This trade, let's just go for an example here. Let's say this is a legitimate swing trade that you entered, where your stop loss goes above the high, because you know you're wrong in the short idea if we make a higher high, and your take profits down here at the low. This is a, on Bitcoin, this is a 27% move, all right? This is a 3.5-to-1 risk-reward ratio trade, which means if you have $100 in your account, this big move, you're risking $1 to make $3.50, all right? Now, let's say price breaks down from here, and then we're looking to short a back test and take it back down to this level, all right? I want you to notice something. If we get into this trade right here, okay, where instead of a 27% move, we're looking for a 17% move, even though it's a smaller move, because we're using a smaller stop loss, this is a 8-to-1 risk reward ratio. So this trade, we're going to make $3.50. This trade, we're going to make $8. All right, let's take another situation here. Let's just say that we are scalping and we have like a super ninja entry right here, okay? And we're just going for a tiny little move like this, right? Just a little 8% move, all right? This trade right here would make you more money than this big trade right here, all right? Why? Because it's all about the risk to reward ratio. A 8% move on a bigger position size that only requires a 0.8% stop loss is going to make more money than a 27% move that requires a 7% stop loss. Your position size is determined by your stop loss. It goes back to the formula. Your risk, how much you're risking, divided by your stop loss percent equals your position size. Don't fall into the trap of looking for massive moves, because it's not the massive move that's going to make you money. It's planning for a trade with good risk-reward ratio using good risk management. And over time, let's say we're down on our low time frame, like the 6 minute or whatever, all right? And let's just say, you know, just as an example, that we have like a little local range to trade throughout the day, all right? This is just an example. It's a 0.6% range, all right? I just want to show you that if the price does something like this throughout the day, okay, and let's, well, yeah, okay, this is just an example, all right. Let's say that the price is in a range like this, and this is kind of what this is like our trading for the day. And a lot of times this happens, guys. I mean, a lot of times, if you're scalping for the day, price will do this in a very small zone, okay? So let's just say price comes in here, right? It comes up, you take a short trade, all right? Guess what? You risked 1 to make 3. You're up 3%, all right? Then we come down here, boom. You risked 1 to make 5, right? So on the day, you're already up 8%. Then you take a short trade right here. You risked 1 to make 4. You're up 12% in 3 trades, all right? And then let's say this one, you risk 1 to make 5, and this one stops you out, all right? You're up 11% on the day, 3 wins and 1 loss, all right? And these are tiny moves, guys. This is like 0.5% move, all right? Do you see how powerful this risk to reward ratio is? People are over here chasing price. People are over here waiting for the big pump, the big next move. If you get this trading thing down, guys, you don't need the big pump. You don't need the big next move, right? You don't need the, wow, look at this pump, honestly, though. It's pumping pretty good, man. You don't need the next move, the big next move. You just need to come in here consistently with your plan and go for those little gains. And eventually, guys, one of these little trades is going to turn into the big one. right? Eventually, one of the little trades is going to turn into the big one. Like this could be the one, honestly. Who knows? Maybe this is the bottom. Maybe this was a big fake out of the bottom of this head and shoulders, and maybe we actually are going to now go to 120K. And if we do, guess what? This trade here is probably going to make me 5 figures, right? Eventually. And so I don't know that right now. I don't know. I don't know, and I can't know, and I don't care, and neither should you. All right? We should come here and we need to execute these risk management strategies with zero emotion. Zero emotion. All right? Understanding that losses are part of the game. We're sticking to our formula so that even if we take a loss, we know it's not going to wreck us, and we just move on to the next trade. What I just told you here is the most important part of trading. If you get this down and you apply this information, you are ahead of 95% of all traders. You could suck at trading. You could be the worst trader in the world. And if you understand this, you're going to actually outperform traders that know a lot more than you. You can go on YouTube right now and you can search random trades with good risk to reward ratio and find people who take 100 random trades and they always shoot for a 3-to-1 risk reward ratio. And after 100 trades, they're in profit taking random trades. Okay. What does that mean? That means you could know nothing about trading, apply this information, and actually be profitable just randomly entering positions. So if you can be profitable entering random positions with this information, imagine now if you have anything else that gives you an edge in these markets, anything that gives you more than a 50-50 shot, something that might give you a 70-30 win rate or an 80-20 win rate. Imagine now having a strategy that gives you a 80% win rate and then applying this good risk management, how over time, even if you don't have the capital, you can build up to something substantial. And then your dream of becoming a trader can actually become a reality. But you got to get out of that mindset of the get rich quick scheme. You got to get rid of that mindset of this one big trade that's really going to make me. No. You come here, you enjoy the process, and you stick to this risk management. All right, God bless you guys, and I'll see you in the next session. Peace.